Boom.
Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and I've got a really special guest today that I'm speaking with. I'm talking with Matt Frailey, who runs the website BreakpointTrades.com. And gosh, I've known Matt for quite some time because we both have been trading these markets since at least 2005. I mean, I know I started in 1999, and I think that's about when I met you at least. And you probably were trading even before that.
Oh yeah. So, um, actually, it was kind of funny. I was going to bring up a little nostalgia, Mike. So, Mike and I both like started back in the '90s. We were in college then, and we both got interested in technical analysis. I think Mike studied history. I was chemistry, but you may or may not cringe about this, but I subscribed to Mike, I think back in 2000 or 99. And I used to just anticipate his little, his newsletters. So, here's what I found on Wayback Machine in
Yeah, no,
2001. And
2001.
I used to really look forward to all these. And, I liked what Mike said. And, he did some technical analysis, but he also did a lot of research. And it was, it was, it was just really, it's, it spoke to me about, what I was doing. And also it showed me that it kind of got me into going to where I was going. So I was a chemist at the time. And, it was an interesting business type model too, analyzing the market, tell people what you thought. So I started Breakpoint Trades. This is actually the original site from say,
What year is
2000,
that?
2003.
Okay.
There was a little audio that used to play here. You could see the flash is no longer works, um, but yeah, I mean, that was the first attempt, Breakpoint Trades way back then, 2003. I was still a chemist at the time. And, I still continued to work for a couple of years, doing this on the weekend when I had a partner who did a bunch of day trade and had a chat room. But, you know, without Mike, I really would have never have gotten into this business format. I mean, I would have, I was obviously into technical analysis and trading the markets, but it's
Well, I've got I could go on and on if I start, but it's, thanks for saying that. It's pretty.
no, I mean, it was inspiring. I
But
mean,
the person that inspired me was a little bit more unsavory. It was someone named Tokyo Joe.
you know
And
what? I remember Tokyo Joe. And back in the '90s, I used to watch him, and yeah, I remember he had some amazing trades. But the market was crazy then, and that
yeah,
reminds me of the market right now. Honestly, I was telling Mike that the moves we're seeing in the market and some of these individual stocks and new issues really reminds me of '99. Like, if you remember some of the old names like JDS Uniphase and all this, I just remember these stocks. They would go from $3 to $30 in a week back then. And now we're seeing kind of the same stuff. We have valuations kind of like we had back then. Again, I don't know when, the Piper will come, but eventually, it will. I mean, there's a lot of folks, like I still think of myself as a young guy, but shoot, I'm almost 50 now. And, there's so many traders out there who never been through the 2008, right?
yeah.
And, so and my sister-in-law, she just got into stocks this year, and she's killing it. But what she's doing is she just a lot of, they call them YOLO traders or millennials, and they kind of they're kind of being conditioned that you buy every dip and you're rewarded. That you know I'm not a big Jim Cramer fan, but he said something that was kind of interesting the other day. He said he was at some party and he talked to some young college kid, and the kid said, can't wait till I save up enough money to buy Tesla. Kramer asked him why. He said, because dummy, Tesla only goes up. And that's the mentality out there now. And I'm telling you, I don't know how long it goes. Does it go over another 6 months? Does it go a year? Eventually there will be a one day when, there's basically too many people that are just making money and long term, things never just work like that. You eventually get some reckoning where the people that don't have the discipline, they don't have a plan and a strategy, you know, kind of get some hard lessons, and that will come one day. All right. And that all leads me into, may seem like a tangent, but that kind of leads me in what we're going to talk about here today. So when you go to my website, it's very strongly focused on technical analysis. One thing I suggest you guys do, read my bio. I had sent it to Mike, but it kind of really goes about, my, what I'd done, kind of how I got to where I am. I'm not going to go through that here. We don't have time, but you can go to the website about us. One thing we do here, Breakpoint Trades, kind of like a boutique technical analysis website. We analyze the market, again, technical analysis approach. We analyze the market indexes, really from a top-down approach. Market indexes, we look at bonds, we look at sectors, we look at commodities, precious metals, and trade ideas. So once a week, or we have 5 newsletters a week, with a bunch of actionable trade ideas and analysis on the market and everything. So there's a lot of stuff here. We got a little community where people post, and we post during the day. And I have a section also with systems. So my background as a chemist, that kind of drove me to technical analysis. Technical analysis, if you could think about it, is, yes, you're looking for patterns in the market, repeatable things, just like you would do if you're a scientist and you run an experiment. You get data, you see if there's some sort of trend there. And that's kind of what we do as technicians. And so that's kind of what drew me to technical analysis. And I eventually got into developing systems, mechanical type trading algorithms. And the ones I started with these SPY type of reversion to mean type trades. Kind of like, so one thing we have here on Breakpoint is a system that I run for the S&P 500. And it's called the SPY system. It's basically a collection of 21 reversion to mean type systems. And what I mean by reversion to mean is not trend following. You can see some examples here. Market gets, say, too stretched away from a short-term moving average. Let's say market goes up 9 days in a row. Well, maybe it's due for a pullback for a day or two, or maybe the market's fallen 10 days in a row, and you find that the odds of a bounce are 90%, historically. So that's what these type of systems look at. They look for statistical, anomalies or rarities where the market, like a rubber band effect, market gets too stretched. It's it's too stretched. It's due for a move in the other direction, and you have a trade opportunity. You get in and you get out. So like here's an example of some of these SPY trades. They're in cash most of the time. You could see here. I mean, they could be in cash for sometimes a month or two. Then they see a high probability trade, take it, then get out. And they wait for another statistical opportunity. I have 22 various systems here. But the one thing I told Mike before about these reversion to mean type systems is that, these are sort of tied to the instrument at hand. So for example, I could do a scan on the S&P 500 and say, okay, over the last 40 years, if the S&P closed 20 days above its 8-day moving average in a row, you have a 92% probability of a pullback, right? But that same statistic, say, might not work on Apple or might not work on some other index or something. So it's sort of curve fit or timed to that instrument. And so what I started doing earlier this year was I wanted to develop this sort of universal system that would say work on any instrument, be no curve fit. You could throw anything on it, and without changing any setting, you could throw any instrument. index stock, and it would just work. And I think I've come up with something. It's pretty intriguing, and it's the most excited I've been about anything in the last 20 plus years that I've been doing technical analysis and system building. Is what I told Mike. And so we all know what happened this year. So just kind of looking at the S&P, we had it's just been a wild 2020, hasn't it, Mike? I mean, just with the COVID and with I mean, if you think about it, guys, the market was down. The S&P was down 35% in a month's time frame from late February to the end of March. And then now it's up nicely.
Just I don't even mean to interrupt you, but I think this year was actually the most volatile. It's the most volatile in our trading career because it fell 33%, the S&P, and went up 70%. It might be the most volatile. I mean, in like a 6 months. That 6 month period from February to Labor Day, it might be the most volatile ever.
It is.
So is it?
Yeah. And, I can do a lot of these, statistical back tests on that. And so, I'm showing you this chart. This is a monthly chart of the S&P. So I'd say 8 years ago, I developed kind of these, I used to call this affectionately 401k paint dry system. And the reason I called it paint dry because it was like watching paint dry. Like it was designed to stay in uptrends for as long as possible, but then avoid a bear market. You know what I mean? Like, so for example, you can see it here. Again, this is each of these candles are a month long. So you can see the indicator right here. You could see it turned red on August or October 30th, 1st, 2000. So that was pretty good exit and didn't get off the top, but that's fine. And then it got back in on here. Told you to get back in on October 2002. Back in 2008, it told you to get out in January 31st, 2008, and then it signaled along back here at the bottom. So it kept you out of the bear markets. It kept you in the bull markets. And it's done that during this whole bull market as well, which is now like 11 years long or 10, which is just crazy. But here's what happened this year. So looking at this old system, notice it didn't turn red here. This is a monthly chart. The market fell so fast here in such a short time that this old monthly paint dry system couldn't respond to it, right? It wasn't, what's worked. I mean, this chart here, I can take it back to the 1960s and you can see, like, here's this 1970s. Remember the 70s, if you do your history reading, it was a pretty volatile year. You had, 1 or 2 years, big rally, you had big sell-offs, and it did a dang good job here. So all the way back. And you can see here, you had this big correction in this time frame, and it didn't signal any exit. Now you might say, oh, well, it did great because the market's at new highs. But for me personally, what it showed is that the markets now have this artificialness to them that, before the markets, like I said, would kind of do this rolling hills type thing, right? You get these bull markets and they would top out and they would do so sort of gradually, right? You know what I mean, Mike? And then they would give you these kind of reliable sell signals early on. And, like 2008, if you think about it, you had some sideways action here in 2007 that allowed indicators to kind of flatten out and moving averages to flatten out. So you can sort of see that something was coming early. But, like this year here, February, March, it was so fast that, this monthly chart couldn't respond. And for me personally, I don't know how you are. Like, let's say I have a 401k, if you're 50, 60 years old and, maybe you have $500,000 or $1 million in it. Do you really want to have a 35% drawdown, right? You know what I mean? Yeah, it's back up now, but what about the next time when it doesn't recover in 5 months, but takes 2, 3, 4 years? You know what I mean? Right? So that kind of led me to develop, something, excuse me, something that would respond quickly, but keep you in trends. So that's what we're going to go over here. And so, you know, one thing I've learned, you know, in the market, you know, most of us use moving averages, right? Most of us use, you know, you use them like, you know, 50-day moving average, 20-day, 200-day moving average, et cetera, right? You know, common stuff. One of the things that led me to this KISS system is take the moving averages and put them on their separate graph. And it creates like a ribbon effect, okay? So you can see it here on this chart. And it tells you things that it doesn't tell you when it's over the candles like this. Like whenever the moving averages say pinch, right? That's when you tend to get your bigger moves. Or, you know, whenever the moving averages flip positive, you could see all this time is, you know, bullish action. You want to be buying pullbacks. You know, you could see, so you could see here when the moving averages flip negative back in February, that was a time to start getting out of Dodge. So I built upon that and I came up with this system that I call the KISS system, which you see here. So this is a daily chart of the S&P, and a couple things you could see here. These are the moving average ribbons that I talked about. This indicator here is kind of a special indicator I made. It's called the BPTMA Deluxe, the very custom moving average. And it has a slope where it turns red. And I found putting that over the moving average ribbons give you this kind of neat trending effect. And then up here, I have this system that generates what we call the DVTs, call them dynamic variable trigger stops. So what the concept here is, this is a trend system, and this is what we use on our website for 401k now. And so instead of the old monthly charts, what it's designed to do is signal a long entry in the market. So you could see, for example, a long entry back here in, say, October 2019. And then price goes higher, and it'll repeatedly draw these DVTs. And so what those are is think of them like you know, an exit. So if the S&P falls below that, say in a 401k or so, or market ETF instrument that you might be in, that would signal you to exit the cash, to safety. All right. It's kind of like a game of musical chairs. You know, when the music stops, you make sure you have a chair. Think of the DVTs like a chair. So here's the 2000 or 20. So it allows you to stay in this uptrend, and it continually raises these stops. And then so you can see what happened here. We have a DVT price at 32.77. So this was hit. This would have been hit on February 24th. Would have signaled you to go to cash. And by the way, I did have this actually in place during this time. And we have one of our subscribers is a financial advisor. He manages around $30 million for his clients' diversified portfolio. He actually used this and he exited all his clients to cash on this date. And so he only took a 2% drawdown while everyone else took a 35% drawdown. And well, the system signaled a long reentry long back here on 324, this line here. These are automatically drawn by the system. I don't draw it, okay? And then you could see kind of what's happened this year. So it went long here, kind of an aggressive oversold entry. It says place a stop here so that you have an exit plan. And then as price moved higher, you could see it would raise these DVT exits. And so here's an example where it would have got you out on June 11th, and then it got you back in June 30th. Now here is kind of, you know, there's once in a while where the system may signal you to get out, and then you get back in, maybe at same prices or even slightly higher. Doesn't happen that often, but that's an example where, hey, the system righted itself and it went back long again later that month and stayed long. It then had you get out the cash. That same advisor, by the way, got out here on September 3rd, 34.90. The S&P, this might not look like much here, was this was a good 10% market correction in September, over about 330 points on the S&P. So then it signaled a re-long entry here, 928, and you can see what it's doing now. 35.96 is where the current, say, stop out would be. And I've done some historical statistics. You know, folks with 401k plans, things like that might say, hey, I don't want to be trading all the time. And this thing will signal these DVTs, I'd say on average are hit maybe 3 to 4 times a year. So, you know, to me, that's not very much. And when I look at the historical statistics on this thing, your market drawdowns are 3, 4, 5% versus, you know, just a traditional buy and hold might be, you know, could be as much as, you know, in 2008 was 50%. So here are some statistics on this DVT KISS system versus buy and hold. And going back to 2006. So you can see the max drawdown on this and the max drawdown on the buy and hold here. You know, you could see the 35% correction there in February. This took a 4%. So anyway, so reason I call it KISS system is because, by the way, this is the 2018 timeframe. The reason I call it KISS is because it's very easy to understand for a lot of folks. And also, Mike, if you look at these moving averages ribbons, there's another thing that shows up here too that's pretty cool. So you can clearly see when the ribbons flip, you obviously want to be looking long if you're not already. One thing I've noticed, every time this BPTMA indicator here, see how it turns red. Every time it pinches into the ribbon, these are buy opportunities. So let's say you're already long, but if you have additional capital, all these are buying opportunities. You know, and you get a little pullback here and here, you don't freak out. You view those as buying opportunities. When the ribbons flip below here, then you're not looking for buy opportunities, right? And, you know, just to give you an example. So here's, we could just throw any stock on here. So here's, what is this? Brazil. So this signaled a long entry in Brazil back in November. And, you know, which was a great entry, and it's protecting the profits. So your current stop out would be, say, 34. What about Tesla? Crazy Tesla. Let's look at that. So here's Tesla. So, by the way, Tesla, it's signaled, if you look at this, it was long Tesla, this system, way back in 2019. You then would have hit your DVT stop out back here in February. It's signaled a long entry here on March 24th. And you can see the DVT prices. It kept you long all the way. None of these were hit, all the way to here, September 2nd. Your DVT would have been hit at 413. So you'd have been out. And then Tesla had a lot of sideways action here. So it signaled a long entry here on 930 and gave a DVT at 407. So you would have been basically kind of more of a sideways trade there. And then it signaled a re-entry here on 1117 at, what is that? 441. Currently Tesla is 640. And you can see there's your stop, 577. So look, here's XLE, that's energy ETF. So it's still long XLE, 36.90, your stop out. You can see your moving average ribbons are pinching here. They went long back here. And if you look, see XLE, it had you long back here from April to early June. You'd have hit your DVT here and it kept you out that whole time. Give me some individual stocks, Mike. We'll just throw some random stuff on here. So for example.
Well, what's Netflix look like?
Let's see here. So Netflix isn't showing along at this point. It's been a lot of sideways action. So if you look, it was long back here, all the way up to here. So you'd hit your stop out at 490 back in July. And then
The one that's how about on Robinhood, they show you the list of the most owned stocks.
So like
one of them has been ACB. It's a marijuana stock.
Okay, let's look at that. Here's Neo. So my sister-in-law owns this. I mean, it's crazy. I mean, some of these moves on these things. So this thing's been long the whole time. And you can see here, price came down. And see, also when it gets close to those DVTs, those are actually potential low risk areas to try long. So you can see it got close to this area, but that's your stop. So like, which one did you mention?
Oh, ACB, Roar Cannabis.
So this isn't long at the moment. So looks like it tried to go long here and then you just stopped out. Again, it's not gonna be perfect for everything, but at the moment it's not long. Now your ribbons here are positive, so I would still potentially be looking for a long entry. But right now, you could see it wasn't long during this time. You could see the moving average ribbons, how they've been negative back here. Really, look, it's been out of it for quite a long time. So it's mainly going to get you in when you start trending. So, like, GDX
saved you money.
Yeah, like GDX, for example. You and I are kind of gold bugs, honestly. And so GDX here, it's sort of long back on 325. You could see the DVTs. You'd have stopped out there in June. Then it had you get back long here in July. And then you just stopped out back here. But it tried to go long here again. But right now it's not really long. It's just kind of, and you can see your ribbons here. They're not really, they're pinching from the underside. So really for this thing to start going long and want to be, it basically wants to see the trend reverse and for these to break, right? Now, if GDX curls back up to this point, I think it'll signal along again. You know what I mean? So, yeah, I mean, so that's kind of, what it's doing is it's, like I said, it's avoiding a lot of these, unless something's going sideways or trending down, it's just not gonna enter. Crude oil, for example, USO. So I think that went long again here. Yeah, that went long back here. It was long crude oil during this time, and then it got out, say, here in September, but it also got out of crude oil back up here back in January 2020, which was a great time to get out. You can see crude oil just dumped, right? It avoided all that, right? So that's what it's good for. So, I mean, it's, hey, it's long again now, as it should be. And then you gives you the stop out level. But anyway, this is the daily. I can take the same chart and make it a weekly without changing any settings. So here's a weekly. Now we also show on the website the weekly S&P, because, there's some people that's, they might like the daily, but they even want to give it more room. So here's the weekly, it's giving it room to 3280, right? But it still does a good job, of catching these trends and still giving you this early stop out. So the weekly here, we still would have stopped you out back here in late February at 3180. But, if you look at the weekly, here's 2008. So this would have got out in 1430 back in mid 2007. And then it stayed out that whole time, 2008. And then it got back in here early 2009. So, and you could just go, here's the 1980s. You could see it had a stop there for the to avoid the 1987 correction. Even though a stop theoretically may not have worked on that 1987 day, the markets obviously weren't like today. You had to call your broker and, they had to run tickets. But, this concept's still there, right? You could see the exit there. I could even take this back to, I think I got a chart of the Dow, back to the 1920s. And so the reason I call it KISS too is because I can take this chart. I could also, this concept works on, I could take, I use it to day trade. I'll put it on 5-minute and 3-minute and 10-minute charts. Yeah, I'll put it on 60-minute charts. So this concept just seems to work on any instrument and time frame. So the that analyst or the advisor, he's through Morningstar, and he actually took our KISS statistics. He threw it into Morningstar. So this is a spit out a report, and the report really kind of shows you the effect here. I know it might be a little fuzzy looking, but let's see. Sorry. Let's see if this can go any higher. So this shows buy and hold. This is the drawdown, and this would be the KISS system. You can see it just basically just take all your drawdowns away, right? Here's the KISS, and here's the buy and hold down here. And probably a better concept would be, this is probably a good example of what the KISS does. So you're uptrending, the KISS system is setting stops at all these higher lows, and then you get out, you avoid this correction, the system gets back at a lower price. And so where the system makes its money on, Mike, is when the markets or stocks have your corrections and you avoid that, you're able to buy back lower. When the market's just trending higher and higher and higher, the KISS system is basically just keeping up with the market. You know what I mean? It's when you get this, the market's stair step. They have 2 or 3 steps up, then they have a step down. When the KISS DVTs allow you to avoid those step downs. And when that adds up cumulatively over time, you know what I mean?
Well, how do people, if someone wants to use this, how would they do it? How do they get the information, or they get?
So there's a couple different things. So right now I'm actually professionally partnered with this RIA group. And so they're actually, as you know how a financial advisor works. So if you go to your run-of-the-mill financial advisor, you give them your whatever, couple $100,000 or whatever it is, they'll look at your age, they'll put that money in to work, or they'll take your age, they'll see your risk factor, your age, and then they'll diversify it across a group of asset classes, 8 or 10 asset classes. They'll put some in the S&P, some in the NASDAQ, small cap, international, bonds, maybe a little gold, some cash. And then what they do is once a quarter, they rebalance. So like this year, for example, the market indexes are up pretty nicely. You and I talked about that. So we'll probably see some rebalancing into bonds maybe late this month, right? Because to reset those averages back, right? If, these money managers, if they're always keeping 10% in bonds, with the market indexes being up nicely, that's going to be out of whack. So they'll rebalance that. But they, typical, financial advisor, local financial advisor, they'll put you in all these different markets, but they'll never exit, right? The whole thought there is, well, if we go into a bear market and the S&P falls 40%, hopefully your bonds and, whatever will make up a little bit of it, right? So this financial advisor, RIA, he runs my KISS system across all these asset classes, technology and large cap. And so what he'll actually get out of these asset classes whenever those DVTs are hit. So this kind of shows an example back in that February, January, March timeframe. So you could see the DVTs signaled an exit of technology on February 20th. Small caps, international, emerging markets, commodities, et cetera. So, and to show you a further example, bonds, right? So let's see, bonds, TLT, all average financial advisors are going to hold a position in bonds because that's what their models would require them to hold 10% of the money in bonds. But bonds have been downtrending. And you can see the DVT signaling an exit back here in August. So he's been out of bonds. So why stay in bonds if the system exits? Why just write it down because of your asset model? So
there's a big chain of financial advisors. They put half their people's clients typically in bonds and half in stocks.
Yep.
And historically, since like 1980, that allocation is pretty much very difficult to beat, and it is safe when you back test that. But now bonds yield nothing, and they don't make any sense. I came into this year with half my money actually in CDs and bonds, 50% of it. But now none of it, not one penny, is in that.
Well, see, in the market,
and I'll never put one in again because what they've done. I'm sorry.
Well, the market is so artificial, as we know, with the Fed. It's in a grand experiment right now, and we don't know how it's going to end, and it's going to be interesting. But that's the neat thing about the KISS system is it doesn't matter really how artificial the market is or not artificial. It's going to work. And so as far as the website and the KISS stuff, like I said, I work with an RIA, and we actually have some of our subscribers who have decided to put their money with that firm, a Solomon API. But on the website, Breakpoint Trades, I have the KISS systems basically every day. So if you go into systems and 401k KISS system, so if you go in here, there's a description. It talks about it, the development of it. And every day, this chart is updated. So here's the current S&P. This is today's chart. You can see I even list, hey, new DVT. There was a new DVT price at $35.95 generated on 12/15. The previous one was 12/4. So people just go to this page once a day and they say, okay, that's my new DVT stop out. So this chart's updated every day on the website. And I also show the weekly for people who want that. I also show we also have a little 120-minute system for people who might want a little faster time frame, but these are updated. Here's the triple Qs. So there's the Qs. 297.20 is the current stop out. So like I said, if the S&P and the NASDAQ want to rally for another 3 weeks or a month before a correction, so be it. We'll get another couple DVTs. But I think probably first quarter at least, we're due for a nice little reversion to mean pullback in the market. Could be 10%, could be a little more. So we're due for some reset, and the DVTs will do their job about helping folks avoid that. So that's where they get it on the website, Mike. These are right on the website. They're also in every newsletter. And every time I send out a newsletter email, like at the bottom of the emails, for example, the bottom of each of our newsletter emails that it says what the DVT is. So now there's a lot of people on our site that want this software. They're like, how can I get that software and put it on my computer? I'm working on some potential ways to do that. I'm not sure if it's a good idea, of course, too, because I kind of view it as a professional type software. And, I'm working with this RIA and, they might be saying, hey, we don't want everyone and their brother with the software, but so I don't know how that's going to work, but otherwise, members on the website, they ask me all the time, hey, Matt, what's the DVT on Apple? And so, let's go and put that in here. What's the DVT on Apple? So here's your Apple. So right now it's 119.80. So, and the Apple went back long on 12.1. You can see here. So it's doing well. So people ask me that all the time. And, my subscribers, I mean, if they're asking me 100 stocks, I'm not going to answer them. But, I have people asking me at least once a day, hey, can you give me the DVT on Apple? Can you give it to me on, Amazon or, AMD or whatever. And, I'll do that. I'll throw it out there and say, here you go. Here's AMD 8520. So that's kind of how people have access to it, but it's pretty cool. It's just kind of like I said, this 20 plus years of working with technical analysis. I kind of came up with this combination of indicators that seem to, work pretty well across almost everything. It's pretty cool. So that's about it. Like I said, I could talk on and on and on, but we obviously don't want to make, what time is it here? 4:47. We don't want to make this too long. So, if there's a lot of interest, we could always, do some future ones and we could like focus in, on some other, examples, right?
Yeah, for sure.
This was kind of like a broad overview. So
yeah, it'd be interesting to look at some stuff in a couple of weeks, see what it's saying, like mid-January, February or something.
Yeah, man. And, so, but yeah, that's it, man. And like I said, it's pretty cool. So, all right, brother. Well, like I said, always nice talking to you, Mike. And I said, Mike and I have been, friends since, early 2000s. We've even met up a couple times in Vegas. It's been a long time. But yeah, man.
Yeah, good talking with you too. We'll keep in touch.
All right. Hey, thanks for the interview, Mike.
For sure.
And, we'll talk again soon. Thank you.